Bitcoin. Bitcoin entered 2025 on a wave of optimism, buoyed by expectations of a more favorable regulatory stance under President Donald Trump. That enthusiasm, however, was short-lived, as renewed trade tensions, particularly tariffs on China and other major partners, reintroduced macroeconomic uncertainty and market volatility. After surging to a record high of $126.20, a rally propelled by unprecedented adoption, particularly among corporate treasuries, Bitcoin has since staged a sharp retreat as risk appetite wanes and investors reassess the shifting economic landscape. The asset is currently trading near $90.30, down 3.45% year-to-date. Despite this price drawdown, Bitcoin's market dominance has actually strengthened, climbing from 58.1% to 59.4%, indicating a flight to quality within the crypto sector even amidst the downturn. Much of Bitcoin's price appreciation from April to October was driven by the accelerating adoption of BTC by publicly listed companies. As the influx of new corporate entrants began to plateau, the momentum behind the rally lulled. This dynamic was starkly visible between August and November, where the slowdown in public company accumulation coincided directly with the easing of upward price pressure. Bitcoin's price momentum also began to stall in August, a shift likely influenced by long-term holders selling their assets. According to Whale Alert, since July, 25 whale addresses that had been inactive for more than a decade moved coins on-chain, suggesting profit-taking or repositioning by early holders. This reintroduction of long-dormant BTC into the market added incremental sell-side pressure at a time when broader demand was already softening. One of the most dominant narratives of 2025 is Bitcoin's decisive break from its traditional 4-year market cycle. This divergence signals a fundamental shift in the asset's market structure, driven by the surge in institutional participation. As professional trading strategies and deep-pocketed capital increasingly dictate market flows, Bitcoin's price action appears to be evolving beyond the predictable, having driven rhythm of previous cycles. Institutional adoption. 2025 saw the institutional adoption of Bitcoin shift from spot ETFs to public treasury companies, while spot BTC ETF flows remain strong. With U.S. spot ETFs seeing an aggregate net inflow of $23.60 public treasury companies saw a larger inflow for the last 5 consecutive quarters. Today, 196 public companies have disclosed Bitcoin BTC $87,318.88 holdings. These digital asset treasury, DAT companies typically aim to increase their BTC held per share through several mechanisms: issuing debt, acquiring BTC at a discount via lock token arrangements with foundations or counterparties, or leveraging their existing crypto through lending and derivative strategies. However, the M/NAV ratio, which measures a company's market capitalization relative to its net asset value, has fallen below 1.00 for most DATs, including Michael Saylor's strategy. This deterioration limits their ability to issue new shares to buy more BTC. In certain edge cases, it may even incentivize companies to sell BTC to repurchase their own shares, reversing their intended accumulation strategy. Despite these constraints, we expect both the number of public treasury holders and their aggregate BTC holdings to continue rising over time. At the same time, we anticipate larger, more capital-efficient players will begin acquiring smaller or less efficient DATs as the sector consolidates. On the ETF side, while recent large outflows have coincided with local market tops, we expect continued net inflows in the coming year as access to digital assets broadens. The integration of crypto ETFs into mainstream platforms operated by large asset managers, including firms such as Vanguard, reduces friction for institutional allocators and expands the potential investor base. Currently, ETFs and DATs collectively hold about 12.8% of the total BTC supply, with global ETFs accounting for 7.42%. This reflects a 35% increase from the start of the year. Assuming a similar growth rate in institutional adoption of BTC, we expect the combined ETFs and DATs holdings to reach 15% to 20% by the end of 2026, continuing to absorb BTC at a rate that exceeds new supply, resulting in a higher institutional share of free float. KPIs to monitor: quarterly ETF net flows, corporate treasury BTC holdings, combined ETF plus DATs holdings, combined ETFs and DATs holdings versus outpacing minor issuance. BTC as a store of value. While BTC has managed to perform well at times in 2025, it has largely underperformed gold in a year marred with macroeconomic uncertainty. The BTC/gold price ratio has declined from 36 to 21, while the market cap ratio has fallen from 10% to 6%. Analyzing the correlation between BTC and other major asset classes such as SPX, Nasdaq and gold, Bitcoin has behaved increasingly like a high beta risk asset, not a clean hedge, especially in short horizons. This divergence was most pronounced during the peak of the tariff crisis, with BTC-SPX correlation exceeding 0.80 while BTC gold correlation declined to roughly -0.75, suggesting Bitcoin was increasingly trading as a risk-sensitive asset, rather than a defensive hedge during that period. We expect Bitcoin to continue like a high beta risk asset, rather than a hedge next year, demonstrated by higher correlation to risk assets, a 0.6 with SPX, and weaker correlation with gold during stress regimes. KPIs to monitor: BTC maintains high correlation with equities, a 0.6 with SPX. BTC sells off more severely than equities during macro shocks. BTC fails to outperform gold on a 12 to 24-month basis. Institutional allocators keep BTC in a high beta tech bucket instead of alternative money/commodity. BTC-Fi and Bitcoin Layer 2 adoption gains traction. Bitcoin's relatively long block times and limited throughput mean it remains an imperfect solution for everyday peer-to-peer payments, especially in a market increasingly dominated by stablecoins and high-performance alternative layer ones. While Bitcoin's on-chain transaction count has dropped from the ordinals-driven highs seen in 2024, activity remains meaningfully elevated compared to prior years. Network fees have also eased from last year's peak, a trend that likely reflects softer transactional demand, rather than major efficiency gains from protocol upgrades. Today, most miner revenues are generated from the block subsidy, while transaction fees account for just 1% of the total revenue, with each having reducing the block subsidy. Now at 125 BTC miners are increasingly reliant on sustained Bitcoin price appreciation to remain profitable. In practice, Bitcoin's price would need to reliably double every 4 years just to keep miner revenue flat, an increasingly difficult assumption. Reflecting this pressure, roughly 15 publicly listed mining companies have announced partial or full pivots toward AI-focused data center infrastructure over the past 2 years. Among the world's top 10 miners, 7 of them are already relying on AI-related revenue to weather the bear market, with 7 generating income from AI/HPC operations and the remainder in planning stages. The underlying economics highlight why this shift is accelerating. despite network hash rate reaching a record 1 ZH/s in October. Bitcoin's price declined to around $81,000, pushing hash rate prices below $35/ph/s, well below the median public miner cost of roughly $44.80/ph/s reported in third-quarter filings. As a result, even the most efficient operators are operating near break-even, with payback periods stretching beyond 200 days and financing costs continuing to rise. Against this backdrop, the role of the broader Bitcoin ecosystem, particularly emerging BTC Layer 2 solutions and the growing BTC-Fi sector, becomes even more critical. These innovations have the potential to meaningfully increase on-chain economic activity and, by extension, transaction fees, which will be essential for the long-term sustainability of the mining industry as block rewards continue to decline. With institutional accumulation now well established, the narrative has shifted from simple exposure to capital efficiency. While institutions have validated Bitcoin as a strategic reserve asset, they remain bound by a fiduciary mandate to maximize returns. In traditional markets, capital is never allowed to stagnate. Bonds accrue interest, equities distribute dividends, and even idle cash is swept into money market funds. Bitcoin, until recently, earned nothing. The total value locked on BTC-Fi and BTC Layer 2s has reached nearly $8 in 2025, highlighting the rising demand and product market fit for this sector. However, not all BTC-Fi or scaling solutions contribute to transaction fees on Bitcoin. Some of these developments and improvements that make Bitcoin more practical as a payments layer, simultaneously reducing the revenue available to secure the base layer long-term. The systems that matter most for miner sustainability are those that generate recurring, unavoidable, and economically meaningful on-chain transactions. Stacks is a well-known example. Its proof of transfer (POX) consensus mechanism requires Stacks miners to make direct Bitcoin transactions to bid for the right to mint STX blocks. This creates persistent L1 demand tied to network activity. Babylon is expanding rapidly as a modular BTC staking primitive. Babylon uses Bitcoin for two essential functions: checkpoint commitments, where POS chains post cryptographic checkpoints to Bitcoin L1, to inherit Bitcoin-grade security, and staking commitments, where stackers publish lockups, unbonding events, and slashing-related attestations on Bitcoin. These operations occur frequently and at scale as Babylon expands to secure multiple chains. Babylon is the largest BTC-associated protocol with a TVL of nearly $5. Emerging Bitcoin rollups like Citria and BitLayer, enabled by innovations like BitVM, operate similarly to Ethereum rollups. They execute transactions off-chain, but post state routes, fraud proofs, or compress data to Bitcoin L1 for settlement. The next decade will determine whether Bitcoin can maintain a credible, market-based security budget after the block subsidy becomes too small to sustain miners. BTC-Fi ecosystems and scaling solutions that require Bitcoin L1 for settlement, proof, metadata, or consensus offer the most realistic path to long-term sustainability.